This video is going to go over support and resistance areas. Some examples of these are Fibonacci retracement levels, Fibonacci profit targets, previous days high and low, previous weeks high and low, previous months high and low, hourly moving average, daily, weekly, and monthly pivot points, 10-day moving average, 20, 50, and 200-day moving average, and there's quite a bit more. A support level is an area where traders are likely to buy. For example, let's say this is the previous month's low and price is coming down to it. It's very likely to stall and reverse at the support level. Sometimes currencies come down to a level and there's clearly buying as it can't go underneath it, and after going sideways for a while it breaks out, then you want to buy and the trend is likely to change. A resistance level is an area where there's likely to be some selling and price is underneath it coming up to it. The farther the market has to move to get to this resistance level, the more likely the resistance levels is to hold. And when it hits the resistance, there's likely to be some selling, which stops the up move, and then price reverses and goes down. One of the key things to remember about support resistance is once a support level is broken, it becomes resistance. Once a resistance sell zone is broken, it becomes support, where there's likely to be some buying. For example, if this is a support level and the market comes down to it and breaks it, which does happen, when it comes back up to it, it's likely to be resistance and the market's likely to stall here and then go back down. In this area where it tests, I like to call a retest, and I'm going to do a separate video on this because you can trade whether intermediate term or scalping just off of support resistance retests. A resistance area where there's likely to be some selling is the same way. Once broken, it tends to become support. When the market comes down to it, it's likely to be some buying there. And even more so if the market held support earlier and then comes down and then shoots above it. If this happens, it's even more likely to become support because traders who had sold here, when the market started to go their way and then reversed against them, at this point they've lost money. And so when the market comes back down to where they initiated a sell position and they're looking to get out of that trade by covering their short position by buying here, and that adds to this level acting as support now. Let's look at some real world trading examples. Notice this resistance area right here. It's the previous day's high. And when the price came up to it the first time, it shot above it, and then coming back down, it did not act as support, and therefore the next time it hit and the next time, the price wasn't able to get above it. Notice the previous day. Price broke above the previous month's high, hit the previous day's high, acted as resistance area, the price came down. Once price broke above it, it then becomes support, and there was buying here and here. And when you see a level get broken and then it comes down and price really can't get underneath it, it becomes a decent place and a high probability place to buy, mainly because your risk is very tiny. If you saw this come down and then went long somewhere around here at 46, your stop is less than 10 pips away and the trend's likely to continue trading in the direction of the trend. And you can see price kind of bounced around between the previous day's high and the weekly pivot level. Sometimes price goes slightly beyond it. Notice it came down and found support at the previous day's low this day and a monthly pivot. Once it broke, the price fell another 20 pips. You would expect this to act as resistance, and if it came back up to that level, couldn't get above it and started to go down, you'd short. But once it breaks back above an area that should be resistance, then you're looking to buy. The resistance area once broken is a sign of strength and the trend's likely to go up. And notice at the time, the weekly pivots here, it was stuck in between these two areas. You don't want to buy here with a likely sell area right above you. But if you find an area that gets broken out and the next likely sell area is a great number of pips away, in this case 30 pips away, you have a very high probability trade because you're risking 10 pips with a good chance of making 30 pips or more. Doesn't mean it's going to stop at this point, doesn't mean that it's even going to get to this point, but this is the next major area where there's likely to be massive selling, and above that here. Fib levels also act as support resistance. If you see a move up, somewhere between the 50 and 62% retracement, oftentimes There are buy orders and the price continues. When price makes a move up and comes down, it oftentimes finds support here at the hourly, found support here and went a little bit through it. And once broken, when the market came back up and retested this at the weekly pivot and the hourly right here, it sold off. Hourly moving average frequently stalls price. As you can see, when the price is underneath the hourly and comes back up to it, it usually stalls there. Once price breaks above it, another good reason to go long right here is that the hourly got broken, the monthly pivot got broken. There was lots of selling areas right here, but once broken, the next area is all the way up here, and that's why it went up. You can see the same thing here today with the euro dollar. The price was trending down. It came back up to the hourly, which oftentimes is a resistance sell area when price comes up to it from underneath. We have a weekly pivot level right here. And when the market proved to you for 3 or 4 hours that it couldn't go up, you go short right here, and obviously the trend continued on the downside. This was a potential profit target. This was a potential profit target. And if it breaks those two, then you have the levels down here. As this thing exploded down and it broke through this resistance area, notice it tested this level and then it tried to go down, but it failed. And once it broke back above this level right here, support resistance traders take a trade because they're risking this small amount right here with the previous day's low and the monthly S2 pivot level up here 35 pips away while risking 10 or 15. When one area of resistance gets broken, and I call it a cluster whenever there's 2 or 3 support resistance areas on an area, this is a cluster. And so if you see 3 areas in a row like this and the market comes up to it, bounces off, and then later on goes through all 3 of them, where the next area of resistance is, if it's just slightly above here, you wouldn't take that trade. But if it's a good number of pips away like this, 25 pips away, you can take that trade, risk 10 or 12 pips, usually with a pretty decent chance of making 25. That's how you use support resistance to trade. Fibonacci profit targets. This first move up right here, if you drew your fibs on it from here to here, you see the Fibonacci profit target. Usually the market stalls between the first 1.382 Fibonacci profit target and the 1.618. If it comes up to this area, and there's especially another area of resistance like the weekly pivot level here, it's a decent place to go short with this, where this is your potential profit target. It doesn't mean these levels are going to get hit. Like you can see here, the market fell about 20 pips, stalled, and then tried to go higher. When it failed to go above this level and came back down, you could have also shorted it here because you now have a double top up here after a pretty extensive up move. Notice how many times the pound dollar comes up, hits hourly, and acts as resistance and comes down. Comes up, hits it, acts as resistance, comes down. Same thing here, same thing here, same thing here, before the trend finally continues. And then today, when it comes back up and hits the hourly, it acts as resistance. If there's any other level right at or near this level, it becomes even more powerful. So this becomes a place to look for sells. Doesn't make that much money. Again here, doesn't make that much money. And at this point, the market breaks above it. You don't want to buy right here because you have these 2 areas of selling right above it. The likely direction is still down, and when it fails to go higher, false breakout right here and goes down, you go short. With this down here is your likely profit target. Also, the whole and half numbers tend to act as support resistance. So support levels that get hit without that much intensity tend to reverse. So you want to add our FX trend intensity on the chart and the IntelliTrend. And if you see these levels get hit with not that much statistical weakness, then it's very likely to reverse. And anytime you see a down move, you can draw your fibs on there, and you can see it touch the Fibonacci profit target to the pip, and there was less momentum that time than the previous move down. So, the market reversed. This resistance area got hit with incredible strength, so it becomes less likely of a place to sell. And if you do sell here, once it starts to break down and it comes down, you see less momentum to the downside than before, then it's not very likely to go through these support levels on the bottom. This is where our tools, combined with just an ounce of common sense, can help you as a trader. Notice this level here. It's probably a Fibonacci profit target of this. It is, to the pip. We have a weekly pivot level here, and the momentum to the up move was half of what it was before. It's very likely to stall here, And aggressive traders can go short there with the hourly moving average as their profit target. It's 25 pips away while risking less than 10 pips. And anytime you can take a trade that's 50% or more, in your opinion, likely to work, where your profit is 2, 3, 4, 5 times bigger than what you're risking, you got to pull the trigger. That's the real secret to trading. Small losses, big wins. And you only do that by looking at where support resistance is, how far it is away from where you want to get in the trade, and is it worth taking the trade. If there was major support right here, you wouldn't have wanted to sell there because the likely reward does not justify the risk. It has to be at the very minimum 1.5 times or more likely profit versus what you're risking. Here the price came up to the hourly, and you can see there was some selling there. It was clearly resistance, and there's another resistance area right above it. It came up with less than extreme momentum. The previous trend down was pretty weak. Notice the monthly pivot acted as support. There was buying here. Once it breaks above that level, you might decide to get into that trade with your stop underneath the low here, because the next resistance is all the way up here, 20 pips away. You're risking less than 10. Once it goes up a little bit and comes down, you're a little bit nervous here. But notice the move down here had almost no weakness in comparison to the strength. This is not any kind of strength to write home about. It's not that special, but it is more momentum to the upside than downside. So as this starts going back up, you move your stop up to break even as soon as it breaks out again, and this is your likely profit target because the market didn't have that much strength. If it had plus 20 strength or higher, you might wait and hold on and try to catch a likely further upside move. And the fact that this market went up to these resistance areas here with moderate strength followed by even less strength, if it makes a double top or a higher high with half the momentum of before, it's very likely to reverse. You might go short right here and the bars go red, and this is your next profit target on the way down. And notice how the market stalls right here. It also does not have extreme momentum, so this support level is more likely to hold because the weakness isn't that much. So you get out of that trade right there with 10, 20, 25 to 30 pips while risking, again, less than 10. That's the whole key behind support resistance trading. And when levels get broken, you can use the retest concept, which I'm going to have a separate video on. Let's try to find one of those examples. I see two examples of retest on the chart here. The market breaks the previous day's low with off the charts momentum. Anytime you see this, it's called a trend explosion system. Usually the trend continues in that direction. Comes back up to the previous day's high here and can't get above it. You might have gone short somewhere around right here. And as the market's coming down, notice there's just no weakness anymore. And at the lower containment bands, the price oftentimes reverses, and that adds to this trade being less likely to work. But you got to get out of that trade with a small profit. Here it comes up to the hourly. Notice that they're selling. It's resistance, like I said. Once it makes a higher high and comes back, and you see that it doesn't break down underneath there, this is a good example, again, of retest. Notice how the hourly combined with the weekly pivot, and you had another support area underneath here was a support area. The price was above the hourly, pulled back, and the momentum was decent, but as it goes sideways right here, it went positive. And you have a nice little wedge pattern right here where the volatility gets smaller and smaller, and those breakouts tend to work. And the bar color, even as the breakout was happening, was dark green, which adds to your probability. And this is a likely profit target. It's a good distance away. Never take a trade where the next sell area is just right above where you're buying. That doesn't make any sense. This is another example of retest. It exploded up with incredible momentum, which, that gives you a higher chance of this level getting broken and therefore price going to the next level. The price came back down and tested the weekly pivot level right here and wasn't able to go underneath it. It also didn't have that much weakness, and so buying it once it broke that trend line projected off the highs was a decent place to get in because you're risking the tiniest amount. You're in this trade around 67, your stop might be at 61, it's less than 10 pips. Your profit target's up here around the whole number. So you have a good chance of making 25 to 30 pips while risking less than 10, and if this level gets broken, then this is your next profit target, and if that gets broken, you can clearly see three major areas of resistance way up here at the highs. One of the reasons it went that far is because the market was extremely strong before, and it became extremely strong again. Our real-time tools showed you that. As this thing was going up, notice the momentum keeps getting stronger and stronger. So you hang on the trade.